All right, folks, welcome to another segment of Freyman CPA, brought to you today by Greg Freyman. And boy, do I have an exciting topic to discuss with you guys today, and one that I really should have brought up a while ago because it's something that's frequently inquired about. So today I want to talk to you about none other than the filing status. And you know, it might seem very simple to you, like, hey, I'm married and I'm single or what have you. It can be very straightforward as I'm single, but once you delve into the realm of I have kids, I have a spouse of some kind, death with the spouse, these kinds of situations already warrant something more serious. And it's not just as straightforward as, hey, I'm married or I'm not married. There's some last minute strategies that people should really be aware of. And that's why I'm putting together this video for you today, is to kind of go over the basics of what these different filing statuses are all about, but also to kind of highlight what's the key differences and some common pitfalls and some common strategies as well. So there should be that benefit. But anyway, this is not, even though it's an introductory topic, I think, because everybody should kind of know what filing status they're in as they're starting to file their tax returns, and you know, they go through life and kind of have like these different situations pop up, whether they're single or they're getting married or they're getting divorced, or perhaps they're having a loved one go through a similar experience and they talk about it with them. So they're kind of understanding these different filing statuses. And obviously we all learn about the very basic ones when we first start out, and that's single. Single is very straightforward. That's you know, how people tend to file. And when they're not married, they're just single individuals. It's very straightforward. There's it's a lower tax bracket than say, for example, married filing separately, and it's pretty much on par with married filing jointly. So let me backtrack a little bit. What is the reason that we have these filing statuses? Well, obviously it's to determine your taxable income and your tax liability. So this is where it starts to vary. It's because you're allowed different deductions, and there's going to be different rates that are going to get involved when you're actually getting through these filing statuses. So if you're single, it means, you know, and depending really which year, because going back, you know, single and married jointly were very different. Now they try to bring the difference down so that it's more of an equivalent between single and married jointly. So if married jointly were really like two people just getting married and combine and doubling up on everything, then that's ideally what really married jointly should look like, right? But in reality, it's not like that. And we'll discuss about all those little intricacies that deals with filing statuses. But just know that here in the States, you know, we have this filing status thing, where in other countries there is no such thing as filing status. Our tax laws come from, you know, the English tax system, and the English tax system actually doesn't have these kinds of filing statuses where single or head of household or married. It's just you're filing as yourself. And it's actually a fiscal year. It runs from April to April instead of January through December like we do. So that's just to give you an idea that that this whole filing status thing was not a thing here in the U.S. It actually became a thing here in the U.S. in 1948. And back in those days, it was our tax system was very much like the English tax system, where everybody just filed for themselves, and then they came out with this other system where you were able to average your income and do a married jointly, and in a way kind of reduce the tax burden. But it didn't really work out that way. But yep, so that's basically what filing statuses are all about, what they're used for. Also, I grew up in the East Coast. Now I'm going to show you how the East Coast rocks. And basically, we're all mainly here on the East Coast. Now I'm going to show you how the East Coast rocks. Non-community property states. For those of you on the West Coast, in states like Arizona or California, where you're probably heard of community property states. And honestly, I didn't hear about this community property or non-community property state laws until I actually started to dive into taxation and worked in tax and started to have an understanding that not every state does things the same when it deals to how the states divide income amongst the spouses. So that was pretty interesting and eye-opening to me, because I always thought that once you marry, everything's kind of split 50-50 unless you have this prenuptial agreement. But it's not actually the case. In community property states, everything that the spouses are earning together are basically split on a 50-50 basis. Some things are still kept individual, and that can be anything like, for example, if one spouse is self-employed, then they'll pay self-employment taxes and have IRA contributions and things of that nature, also on an individualized basis. But other than that, you're kind of averaging the income amongst the two. So if one spouse makes, $60K and the other one makes $10K, in actuality, it's $70K combined. And if they were to do a married filing separately then each one would actually report $35K. There are other items that would not be reported this way, and those are usually items that they've gathered from before their marriage. So perhaps a savings account or something of that nature that came before marriage. That would be something that's not community property. But once you married, it's basically 50-50 down the line. I'm not going to jump into what that means. Just know that on the East Coast, most states in general are on a non-community property basis, and what's mine is not yours. I've earned it, it's mine, it's my income. If I'm married separately, I'm not splitting that up with you. I'm reporting all of my income that I've earned, and that's going to go on my, if it was a community property state, then it would go all on me, and it would be my, basically my income to report, and I wouldn't be splitting it 50-50 with my spouse or anything of that nature. So that's basically community property, the concept of what community property is, our tax laws, filing statuses, and that's plenty for starters. So I'm going to cut it right here, and I'm going to dive into the next section, which we're going to discuss with you guys, which is what is married for federal tax purposes, what is considered unmarried, and then we'll dive into these married jointly separately issues, which is really the hot topic because everybody wants to know about that. Stay tuned.
Yep, I'm back. It was the best time to get loose. I took a bite out of crime, washed it down with some juice. I'm not the new kids, but I'm knocking blocks off Sunday. Yep, I rock like the Stones, plus I'm rolling in the money. So, diggity yikes, I'm hype. I know you dig me.